Hi, I'm Jim Jubak, and welcome to my YouTube video for July 7th. It's a hot day here in New York. If you'd like to find a little humor in the global warming Armageddon, I'd strongly suggest there's a cartoon feature on the Guardian newspaper site, written from an Australian point of view, called First Dog on the Moon. And today's strip is about the natural gas leak in the Gulf of Mexico that set the ocean on fire. So lots of good news to look forward to. If you want more of my stuff, please go to my free site, jubakpicks.com. If you'd like even more and would like to pay me, go to my subscription site, jubakam.com. The free site has 3 portfolios. The paid site has 6 portfolios, including one for millennial investors, one that includes some options plays. You can find the links to that down below. Unless you've been living under a rock for the last few days, you know that there was a big collapse in the OPEC meeting on Monday, Tuesday. What happened on Monday is that the OPEC Plus meeting dissolved in chaos. There was a tentative agreement in place to increase production because the global economies recovered starting in August, but the OPEC nations couldn't agree on how much to increase production. They couldn't agree on how to measure it. They couldn't agree on who was going to get the extra production. Basically, we wound up with a fight between Saudi Arabia on one side and the United Arab Emirates on the other. What has happened is that oil prices have been all over the place because no one knows exactly how this is going to work out. Oil prices rallied immediately upon the news on the idea that we're going to see the August increase in production won't go through. And then oil traders thought about it a little bit and said, oh, well, this really means that the likelihood is without an agreement, people will produce as much oil as they want. So what we're looking at is a very important sort of turning point in the way that OPEC looks at the world. The Saudis represent the old way of looking at the world, which is you control supply so you can keep oil prices up, and so that pumping oil is profitable as possible, and you sort of regulate demand by regulating how much you produce and what the price of oil is going to be. The UAE, the United Arab Emirates, is not a green voice at all, but they are adopting a kind of green take on the future of the oil industry. And basically what they're saying, as I read it, is that we're looking at a point where sometime down the road, oil demand is going to fall off a cliff, and therefore, in the short term, oil producers, especially low-cost oil producers like the United Arab Emirates, should pump as much oil as possible, because at some point, the likelihood is that we're going to wind up with stranded assets. So if you don't pump it now, you're going to lose it. And that's what I think is the real threat to any kind of green energy initiatives, green energy stocks. If oil prices go really down, it's going to be very hard to raise capital to invest in things like electric vehicles and chargers and the grid and all of that stuff. And so what happened today, we've got West Texas Intermediate, which is the US benchmark, down to about 71.60 or so. That's down about 2 3/10% on the day. Brent, the international benchmark, is down about 2.01% to 73. So we've got WTI, the US benchmark at 71, $72 a barrel. Brent at $73 a barrel. At these prices, I think you're looking at countries like Russia and the UAE producing more oil. I think they're going to pump more. They've got budget problems in Russia. They really need the cash. They're going to produce. A lot of the US shale producers locked in futures as a way to lock in future prices when oil futures briefly hit $77 a barrel on Monday. So we've got a lot of producers sitting there with good lock-ins on production. I don't think that means that we're looking at a lot more production in the short term. I think because these companies really need the cash flow, so they're not going to invest in reopening production. But in the longer term, I think we're going to see more oil, lower prices, is my prediction. So if you want to look at this, we'll look at some charts. This is a chart for USO, United States Oil Fund. You'll notice that it's been up and up and up. We've had a recovery as demand has recovered, and then it fell off strikingly on Monday and Tuesday. If you want to look at another oil chart, this is the Energy Select Sector Spider Fund. It's an it's a ETF. Again, not as rapid and firm an increase because this tracks a lot of things, not just the price of oil. But again, you notice that it fell off the little cliff in recent days. Here are the charts of two U.S. oil shale producers. This is Pioneer. Again, big recovery, and then blah, 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 blah. The problem with oil shale is that at lower, it's a question of where price has to be to get big increases in production. It's probably not at 71, it's not at 68. Daniel Yergin, who's been a long-time follower of the oil industry, says the shale industry is going to produce an extra 200,000 barrels a day in 2021, not a big increase, and he sees that going up to an extra production of 400,000 barrels a day in 2022 as companies decide, hey, prices are here to stay. This could all wind up going in the proverbial toilet if we wind up seeing oil prices fall because of extra production from the UAE and Russia. Last one is a shale producer called Devon Energy. Okay, here's Devon. You see, this Devon has been Pioneer has been a relatively well-run oil shale producer, so it didn't show the big increase because it wasn't really pounded. Here you've got Devon showing really big gains because they were sort of, people were going, well, what's going on with Devon? What's going on with Devon? So this has been a really big change for them. So that's what's going on with oil. We don't know what is going to happen with OPEC, but we also are seeing the uncertainty about oil prices and the likelihood that oil prices are going to go down sort of ripple out through the rest of the financial markets and the commodity markets. The dollar has climbed in the last couple of days on these developments from OPEC. The yield on the 10-year Treasury has been falling as Treasury prices have gone up, again, partially because of turmoil, because it's a safe haven, but also because lower oil prices, if that's what's going to happen, would mean less likelihood of a Fed increase, less likelihood of inflation. So today we're down to 1.32 on the 10-year Treasury. It's a very low yield back where we were in February. Another 3 basis points falling. So this and commodity prices, whether it's lithium or copper, have all been going down with oil. The big danger here, if you want to find an asset class that's looking to be really on the edge, is probably emerging markets. A stronger dollar hurts those currencies. Lower commodity prices hurts those economies. So the iShares MSCI emerging markets ETF is someplace to look for very strong downturns on any turmoil downturn in the oil market. Okay, so that's my read on what this is going. I would watch this because it's going to ripple out over a lot of things. We're looking probably at stronger dollar. We're probably looking at stronger bond prices, falling treasury yields. In the short term, let's say over the next month or two, this is one of the key drivers for commodity prices. Okay, so that's my spiel for today. If you like this video, please like it. And of course, subscribe to my YouTube channel because that way you can see what's coming down the road. You'll get notifications on all the videos we're doing. And as I say, we're going to 2 videos. And of course, if you want more of my stuff, you can go to my free site, jubakpicks.com. Down below is the link. My subscription site with more portfolios, more commentary on the market, more picks. It's jubakam.com. And again, that's down below. Thanks very much for watching.